right now, the most powerful central banks on Earth are, they're quietly dumping United States debt, like hoarding physical gold in their sovereign vaults at a record-breaking pace.
Yeah.
And at the exact same time, the value of the U.S. dollar is just soaring on global currency charts, which, those two facts contradict literally every basic foundational rule of modern economics that we're traditionally taught.
Right. It doesn't make sense on paper.
Exactly. I mean, you cannot have the ultimate insiders abandoning a currency while the market simultaneously bids its value up to the moon. Something in the machinery of global finance is breaking, or, well, at the very least, it's rapidly reconfiguring itself.
Definitely.
So today is Monday, May 11th, 2026. Welcome to the Deep Dive. We've gotten our hands on this really dense, urgent dispatch from a well-known market and geopolitical commentator who goes by the name Metin.
Yeah, and his analysis is intense.
It really is. He's calling the current global situation a perfect storm. We're looking at a scenario where high stakes, global geopolitics, sudden constitutional court rulings in the U.S., and exploding precious metals markets are just violently colliding.
Yeah, and the stakes outlined in this text are honestly staggering. I mean, we are looking at a cascading failure of traditional predictive models. Everything we thought we knew is being tested.
Right.
But before we jump in and start dissecting this data, we need to establish some ground rules for you, the listener, as we navigate this specific source material today.
Good idea.
Because Metin's dispatch, it covers some highly charged, ongoing political and military realities. I mean, we'll be discussing specific U.S. tariff policies, specifically from the Trump administration, severe military tensions in the Middle East involving Iran, complex trade dynamics with China.
Yeah, it's a minefield.
It is. So we want to be incredibly clear right up front. We are not taking any sides here.
No.
We are not endorsing the policies, the politicians, or the geopolitical maneuvers mentioned in the text. Our mandate for this deep dive is strictly analytical. We're just here to unpack the reality of the data presented to us and examine the interconnected mechanics of global trade, exactly as Metin has laid them out.
Right. We're essentially just mechanics today.
Exactly. We are here to dismantle and understand the engine of this crisis, impartial to who is currently sitting in the driver's seat.
Okay, let's unpack this. We need to start right in the center of the domestic storm, which is Washington, D.C. The anchor point for this entire crisis occurred just a few days ago, on May 8th.
Right.
The U.S. Court of International Trade handed down a ruling that effectively slammed the brakes on the current economic strategy, which Metin refers to in the text as America First 2.0.
Which is a huge deal.
Huge. We were talking specifically about the universal baseline tariffs. These were sweeping across-the-board tariffs ranging from 10% to 20% on foreign goods, and the court basically deemed these baseline tariffs unconstitutional. But to understand why this is causing such a violent ripple effect across everything, we really have to break down the step-by-step mechanics of what a tariff actually is. Because, it's often so misunderstood in mainstream headlines. I mean, a tariff is not a check written by a foreign government and just handed over to the U.S. Treasury.
No, not at all. It's actually a tax paid by the domestic importer.
Right.
So let's say a retail chain in the United States imports a shipping container of televisions from overseas. That U.S. company is the one who pays the 10% to 20% tax to U.S. Customs and Border Protection at the port of entry.
Got it.
And then, of course, the company passes that extra cost directly onto the consumer. So the television that cost, $1,000 last week suddenly costs $1,200 today.
Yeah, you feel it at the register.
Exactly. But the crucial part of this America First 2.0 strategy was what the administration planned to do with that massive influx of customs revenue. The whole mathematical pillar of their budget was to capture that tariff revenue and use it to offset sweeping domestic income tax cuts.
Right, so it functions as like an economic closed-loop system. You tax the point of entry for foreign goods, which theoretically protects your domestic manufacturing, and then you take that new capital to lower the internal tax burden on your own citizens and corporations.
That was the plan, yeah.
But the May 8th court injunction didn't just stop the tariffs. It severed that entire mathematical loop.
Completely severed it.
So the revenue projection instantly drops to zero, meaning the planned domestic tax cuts now have zero funding mechanism. And with the White House preparing an appeal, it introduces this prolonged, grinding legal limbo into the U.S. economy.
Yeah, it's like pulling the foundation out from under a house right as the roof is being shingled. Everything just stops.
That is a perfect way to put it.
Yeah.
And that brings us to the glaring contradiction in Metin's dispatch that we opened the show with. If the core U.S. economic agenda just hit a massive, maybe fatal speed bump, And the mechanism for domestic tax cuts is paralyzed in this constitutional court battle.
Right.
Why is the U.S. dollar index, the DXY, still hovering above 106? I mean, if the National Economic Plan is failing, basic logic dictates the currency should be plummeting, right?
You'd think so. But what's fascinating here is that the DXY is hovering above 106 precisely because the mechanics of market panic operate completely differently than the mechanics of domestic economic policy.
Okay, break that down for me.
So let's look at what the DXY actually is. The US dollar index doesn't measure the dollar in a vacuum. It measures the dollar against a basket of major foreign currencies, primarily, the euro, the Japanese yen, the British pound, and the Canadian dollar.
Right, it's relative.
Exactly. And the DXY is currently sky high because global investors are terrified of what Metten calls trade war 2.0. Even though the court paused the U.S. tariffs, the administration's intent is very clear, and the appeal process guarantees that the threat remains active.
Yeah, the sword is still hanging there.
Right. And when investors see the threat of a global trade war, they engage in a massive flight to safety.
Wait, okay, hold on. If the U.S. is the epicenter of the trade war and the epicenter of the legal uncertainty,
Yeah.
why is the U.S. dollar considered the safety asset? Like, why wouldn't capital flee to the euro or the yen?
That's a multi-trillion-dollar question, and the answer is the deep plumbing of the global financial system. The vast majority of global debt, international trade contracts, corporate borrowing, it's all denominated in U.S. dollars.
Okay.
So when panic hits, we see a phenomenon known as a liquidity crisis, which very often triggers margin calls.
Margin calls. Okay, explain how that works in this context.
Well, let's say you are a massive hedge fund in London, okay? And you've borrowed millions of dollars to invest in emerging market stocks. The threat of a trade war causes those stocks to drop in value.
Right, because emerging markets get hardest in a trade war.
Exactly. So your broker issues a margin call demanding that you deposit more cash immediately to cover the risk of your loan. And because your loan is in U.S. dollars, you must supply U.S. dollars. You don't have a choice. You are forced to sell whatever assets you have, whether that's euros, yen, gold, stocks, whatever. You have to desperately buy dollars to meet that margin call.
Oh, I see.
Yeah, and this forced buying creates a massive artificial demand for the currency. So the high DXY isn't a badge of American economic health at all. It is literally a global thermometer measuring the sheer volume of forced liquidations and institutional anxiety.
That is wild. That structural demand mechanism completely flips the whole narrative. The dollar isn't strong because the U.S. economy is invincible. The dollar is strong because foreign entities are legally obligated to acquire it during a panic.
That's exactly it.
And because the DXY is at 106, I mean, that creates a powerful vacuum, right? It's sucking capital out of emerging markets and applying unbearable pressure to foreign currencies.
Right.
And no market is feeling that more intensely right now than China.
Oh, absolutely.
Metten's dispatch describes China's current position as a masterclass in playing a highly defensive game. Because the U.S. court ruling on May 8th, it did give Beijing a temporary breather on those broad 10% to 20% tariffs, but the text is explicit. The strict, targeted technology embargoes, specifically regarding advanced semiconductors and military-grade tech components,
Right.
those remain fully in place.
Yeah, they didn't go anywhere. China realizes they can no longer rely on the United States consumer market as the primary engine for their economic growth.
It's done.
Right. The paradigm of the last 30 years has permanently fractured. And consequently, Metten points out that China is executing this massive structural pivot. They are doubling down on BRICS plus trade, focusing their exports on Brazil, Russia, India, South Africa, and, the expanding network of aligned emerging economies.
Yeah.
But the really significant detail in this dispatch, the part we really need to look at, is the mechanism by which they are trading. They are actively trying to bypass the SWIFT banking system entirely.
Okay, let's define SWIFT for the listener, just to be totally clear. SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication. And it isn't actually a bank, right? It doesn't hold any money.
No money at all.
It's essentially the secure messaging network that international banks use to send instructions to each other. So if a company in Germany wants to pay a manufacturer in Vietnam, the banks use SWIFT to securely communicate the transfer of those funds.
Exactly.
It's basically the central nervous system of global finance.
Yeah.
But the catch is, it's heavily monitored and influenced by Western U.S.-aligned interests. And the U.S. uses access to SWIFT as its primary enforcement mechanism for global sanctions.
Right. And if you are cut off from SWIFT, you are effectively excommunicated from the modern global economy. China watched the U.S. completely sever Russia from the SWIFT system back in 2022. They froze hundreds of billions in sovereign reserves literally overnight.
Overnight, just gone.
And for Beijing, that was the Rubicon. Relying on SWIFT is a catastrophic strategic vulnerability for them now. So bypassing it isn't just some theoretical exercise or a financial flex. It's a matter of absolute national security.
Right.
They are building out CIPS, which is the cross-border interbank payment system, and that clears and settles international claims in renminbi rather than U.S. dollars. They're also aggressively expanding bilateral currency swaps.
Okay, let me jump in right there. A bilateral currency swap, it sounds really complicated. But mechanically, how does that actually circumvent the U.S. dollar? Like, what does that look like on the ground?
Sure. So in the traditional system, if China wants to buy oil from Russia, China has to exchange its yuan for U.S. dollars on the open market.
Okay.
Then they send those dollars through SWIFT to a Russian bank,
Right.
and then the Russian bank exchanges those dollars for rubles.
Wow, so many steps.
Right, and in that process, the U.S. dollar acts as the mandatory middleman. It takes a tiny fraction of a cent on every transaction, but more importantly, it allows the U.S. to monitor the trade.
Right.
But a bilateral swap eliminates that middleman entirely. The central banks of China and Russia simply agree to a direct exchange rate between the yuan and the ruble.
Oh.
Yeah. So China pays for the oil directly in yuan, which Russia then uses to buy Chinese manufactured goods. The U.S. dollar and the SWIFT system are completely bypassed.
Okay, that makes total sense.
Okay.
But looking at the dispatch, it paints a picture of a country under immense immediate pressure while trying to execute this really long-term systemic pivot.
Yeah.
Because Metin notes that the USD to CNY exchange rate, the US dollar to the Chinese yuan, is under heavy pressure at 7.35.
Yes.
He explicitly calls this a tightrope walk. They are trying to balance a collapsing domestic real estate market against the desperate need to keep their exports cheap and competitive. But honestly, the metaphor of a tightrope, it implies balance. And the mechanics here sound way more volatile than that. It sounds more like managing the pressure valve on a massive industrial steam engine.
A steam engine is a far more accurate mechanical metaphor for what is happening at that 7.35 peg, for sure.
Right.
Because China's domestic real estate market, which accounts for just an enormous percentage of their national wealth and their GDP, is suffering a profound structural collapse.
Yeah, we're talking major property developers defaulting.
Construction halted on massive projects. Regular citizens' wealth is just vanishing. So to keep the engine running, to keep factories open, and people employed just to stave off civil unrest, China desperately needs to export manufactured goods.
Okay.
And to do that, they need to vent the steam. Venting the steam means intentionally weakening the yuan.
Oh, because if the yuan is weak compared to the dollar, then Chinese goods become artificially cheaper for foreign buyers.
Exactly. A weak currency essentially subsidizes their entire export market.
And this is where the pressure valve comes in. If they vent too much steam, like if they let the yuan weaken too rapidly, they lose all the pressure in the engine.
Right.
Citizens and corporations will look at the falling currency, they'll look at the crashing real estate market, and they will absolutely panic. They'll scramble to move their wealth out of China into U.S. dollars or gold or foreign real estate. That's a massive capital flight.
And we have historical precedent for how devastating capital flight can be. Just look at the 1997 Asian financial crisis.
Right.
Countries like Thailand and Indonesia, they tried to maintain artificial currency pegs. And when the market realized those countries didn't actually have the reserves to defend the peg, speculators attacked. The currencies broke. And that led to mass bankruptcies, skyrocketing inflation, deep economic depression.
Yeah, total chaos.
And Beijing is terrified of a 1997-style collapse. They cannot let that happen. So they have to turn this pressure valve with microscopic precision. They actively intervene in the foreign exchange markets, literally burning through their own dollar reserves to artificially prop the yuan up just enough to prevent psychological panic and capital flight, but while keeping it just weak enough to ensure their factories survive. So that number, 7.35, it's not just an exchange rate. It is the exact PSI reading on a steam engine that is currently pushed to its absolute structural limit.
That is terrifying. And, an engine running at its absolute structural limit requires physical fuel to keep functioning. I mean, you cannot manufacture solar panels or electric vehicles, and you certainly cannot ship them across the ocean to the BRICS plus nations without massive amounts of energy.
Nope.
Which brings us to the next variable in Mithen's dispatch, and honestly, arguably the most volatile catalyst on the whole board, because the world's most vital energy artery is currently under direct physical threat.
Yeah, this is where things get really tense because over the weekend, reports surfaced that a Barbados-flagged oil tanker was seized by Iranian forces in the Strait of Hormuz.
Yeah.
And just for geographic context for the listener, the Strait of Hormuz is this incredibly narrow waterway that connects the Persian Gulf to the Gulf of Oman and then out to the open ocean. Now, while the strait is roughly 21 miles wide at its narrowest point, the shipping lanes that are actually deep enough to handle massive oil supertankers are only about 2 miles wide in either direction.
2 miles. That's nothing.
It's nothing. And an astonishing 20% to 30% of the world's total daily oil consumption passes through this specific 2-mile stretch of water.
It's a massive bottleneck.
Exactly. And Metin refers to this geographical choke point as the Hormuz Lock. By physically seizing a vessel here, Iran is demonstrating its capability to turn the key in that lock and just shut off the global energy supply.
And we've seen this specific playbook before, right? Like during the Iran-Iraq War in the 1980s, the world witnessed the tanker war phase. Both sides began actively attacking commercial oil vessels in the Gulf to economically cripple each other.
Yeah.
And it got so bad it forced the United States Navy to intervene with Operation Earnest Will, where they were physically escorting Kuwaiti oil tankers through the strait just to keep the global economy from suffocating.
Exactly. And the market remembers that history very well. The text notes that the immediate reaction to this weekend seizure is that Brent crude, which is the primary global benchmark for oil prices, is skyrocketing. Metin uses this incredibly evocative phrase, stating this oil spike is, quote, pouring gasoline on the fire of global inflation.
Oh, man. Let's talk about the mechanics of that. Because the mechanism of oil pricing impacts literally every single node of the global supply chain.
Every single one.
When Brent crude skyrockets, the cost of the diesel fuel powering the cargo ships goes up. The cost of the jet fuel for air freight goes up. The cost of the petroleum used to manufacture the plastic packaging goes up. The fertilizer used to grow the food goes up.
Right.
It's just an immediate, inescapable tax levied on the entire global economy. And normally central banks try to fight inflation by raising interest rates to cool down consumer demand. But raising interest rates doesn't magically manufacture more oil, right?
No, it doesn't.
And it certainly doesn't secure a maritime choke point. So an inflation spike driven by a physical supply shock in Hormuz renders traditional central bank monetary policy completely impotent.
Yeah, they are effectively powerless against a physical supply shock like this. But the dispatch escalates this way beyond pure economics. We are looking at a severe military crisis here.
Right.
U.S. Secretary of State Rubio has issued an ultimatum demanding that Iran respond to U.S. peace terms immediately or face, quote, unprecedented military consequences.
Yeah, unprecedented military consequences.
Because that is heavy language.
Extremely heavy. And this brings up a critical behavioral anomaly in the market that I think we really need to dissect. Because Metin explicitly mentions there is a diplomatic back channel operating through Pakistan right now.
That's right.
A potential off-ramp exists to avoid war. Yet, the text states the market is completely ignoring it.
Yeah, I wanted to ask about that. Why? Like, when the stakes are this high and there's a diplomatic back channel right there, why do financial markets entirely discount the possibility of a peaceful resolution?
Sure.
It comes down to the mathematical asymmetry of risk and how modern trading infrastructure actually functions today. You have to understand that the majority of daily trading volume isn't executed by human beings sitting at desks, drinking coffee, and analyzing diplomatic nuance.
Right.
It is executed by high-frequency algorithmic trading systems. These algorithms utilize natural language processing to scrape global news feeds in milliseconds.
Wow.
So when a program reads a phrase as severe as unprecedented military consequences issued by a U.S. Secretary of State, it does not wait to verify the geopolitical context or look for a Pakistani back channel.
It just reacts.
Exactly. It is hard-coded to instantly dump risk assets and buy safe haven assets.
Okay, so the machines sell first and ask questions later. That makes sense. But what about the human institutional traders, the ones managing billions in pension funds or whatever? Why are they ignoring the peace channel?
Because the humans are bound by the exact same grim mathematics of risk management. Let's just model the asymmetry here. If a trader believes the Pakistani back channel will work and peace will prevail, oil prices might drop, say, $5 or $10 a barrel. The global supply chain normalizes.
Great.
The upside of betting on peace is moderate. You make a little bit of money.
Right.
However, if the back channel fails and the U.S. actually initiates unprecedented military consequences, the Strait of Hormuz becomes an active war zone. Oil doesn't just spike. It could instantly gap up to $200 or $250 a barrel.
Oh, my God.
Global shipping insurance rates become astronomical. Physical supply lines halt entirely. The financial destruction of betting on peace and being wrong is absolute. Your fund is wiped out.
That is a brutal reality.
It is. Therefore, responsible institutional risk managers literally cannot afford to price in the whisper of peace. They are mathematically forced to price in the worst-case scenario because it is the only way to ensure the survival of their portfolios if the worst-case scenario actually materializes.
Wow. So the market's self-preservation instinct creates this self-fulfilling prophecy of panic pricing.
Exactly.
So just recapping where we're at, we have a paralyzed domestic economic agenda in the U.S., causing a margin call-driven spike in the dollar.
Yep.
We have China walking a literal tightrope with its currency while desperately trying to build an alternative banking system to survive.
Right.
And we have the threat of an outright military conflict choking off 20% of the world's oil, pouring fuel on an inflation crisis that central banks cannot solve.
It's the perfect storm.
It really is. So the fundamental question for the listener right now is, when the fiat currency system is this fragile and the globe is this volatile, where does the sovereign institutional smart money actually go? Like, where do they hide?
Well, according to the hard data in Menton's dispatch, the capital of sovereign nations is flowing directly into the oldest, most fundamental safe haven in human history.
Gold.
Gold, exactly.
Okay, let's examine the XAU to USD chart. The dispatch notes that gold is currently trading in a consolidated range between $4,745 and $4,867 per ounce.
Right.
And Menton points out that this is a slight pullback from a staggering high of $5,500 earlier in the year. But he is adamant that this pullback to the $4,745 level is not a market crash, and it's not a loss of interest. He defines it as the establishment of an incredibly strong floor.
Yeah, and this floor is not being built by retail day traders or speculative hedge funds. It is being built by the central banks of sovereign nation states,
Look at Bangladesh.
the biggest players. Menton's text explicitly links this price floor to the concept of de-dollarization, stating that the shift away from the U.S. dollar is rapidly moving from a theoretical talking point to a physical reality. Central banks across the globe, particularly in the BRICS Plus bloc, are systematically dumping U.S. treasuries, which is the sovereign debt of the United States government.
Right.
And they are replacing those paper assets by stacking physical gold in their own domestic vaults at a record pace.
Okay, hold on. Wait a minute. We need to reconcile a massive logical paradox right here.
Yeah.
Because in our first segment, we established that the dollar index, the DXY, is high, hovering over 106. And you explained that global panic and margin calls are forcing entities to aggressively buy dollars. But now, the text states that the most powerful financial institutions on Earth, the central banks, are aggressively dumping dollars.
Right.
If the largest holders of U.S. debt are selling it off, who on earth is buying it to keep the DXY elevated at 106? How can both of these realities exist at the exact same time?
That is a great question. And resolving that paradox is probably the most vital macroeconomic lesson of this entire dispatch. You have to understand that there are two entirely separate, completely parallel liquidity pools operating in the global economy right now.
Okay.
The first pool is the Eurodollar system and the commercial financial sector. So this is the realm of multinational corporations, hedge funds, and private banks.
The commercial guys.
Right. When a crisis hits, this sector faces immediate short-term liabilities. They have payrolls to meet, supply chain invoices to settle, and as we discussed earlier, margin calls to cover. And the overwhelming majority of these short-term obligations are legally denominated in U.S. dollars. So in the short term, this massive commercial pool is essentially forced to blindly buy dollars just to survive the week. That frantic commercial buying pressure is exactly what keeps the DXY at 106.
Okay, so the commercial sector is trapped in the dollar infrastructure.
Completely trapped.
What is the second pool then?
The second pool is the sovereign reserve sector. This is the realm of central banks and national governments.
Right, to states themselves.
Exactly. They are not worried about making payroll next Friday. They are planning for national survival over the next 50 years.
Right.
They watched the U.S. government unilaterally freeze the dollar reserves of a major geopolitical power in 2022. They realized that U.S. treasuries are not truly risk-free assets. They are digital IOUs that exist entirely at the pleasure of the American banking system.
Wow. Yeah.
If a nation angers Washington, perhaps over a trade dispute or a military alignment, their national savings can literally be vaporized with a single keystroke.
So the fundamental nature of trust in the fiat system just broke.
Exactly. The trust is gone. The central banks realize that holding the paper debt of a geopolitical rival is a massive strategic liability. They require an asset that provides true sovereign immunity.
Something you can't just delete.
Exactly, an asset that cannot be sanctioned, frozen, or digitally erased. They require an asset with intrinsic physical value that physically sits within their own borders, guarded by their own militaries.
And that asset is gold.
That asset is gold, and this completely explains the paradox you brought up. The commercial sector is buying dollars out of short-term, panicked necessity, driving the DXY up. Simultaneously, the sovereign sector is systematically dumping dollars to acquire physical gold for long-term strategic survival, building that massive $4,745 price floor. We are witnessing the architectural bifurcation of the global financial system in real time.
That is just incredible. That distinction between short-term commercial necessity and long-term sovereign survival is really illuminating. So gold is basically acting as the impenetrable vault for national wealth. But as fascinating as gold's role is right now, Menton's dispatch explicitly reserves its most aggressive, bullish language for a different metal entirely.
Oh, yeah, he does.
He calls silver, quote, the real star of this crisis.
Yes. While gold is the defensive anchor, the text highlights the XAG to USD market, silver, as the explosive growth asset.
Which is so interesting. According to the data, silver is currently trading between $80.35 and $80.87. It has experienced a massive 6% gain in just a matter of days, vastly outperforming gold's percentage movements.
Yeah.
So why is silver, this notoriously volatile, cheaper metal, suddenly the star of the show during a global macroeconomic meltdown?
Because silver's underlying fundamentals are driven by a dual-engine model, which makes it entirely unique compared to gold.
Okay, unpack that.
While gold is almost exclusively a monetary asset, we mine it, we refine it into bars, and we lock it away in dark vaults to sit inertly as a store of value. It does not really get consumed.
Right.
Silver, conversely, operates as both a monetary safe haven asset and a hypercritical industrial commodity.
Okay, yeah. Menton details this intersection perfectly. He points out that silver is currently trapped between a severe physical supply scarcity and a booming, inelastic industrial demand.
Let's look at the physics of the metal for a second, because it's important. Silver possesses the highest electrical and thermal conductivity of any known metal on the periodic table.
Really? Any metal?
Any metal. Because of this immutable law of physics, there is quite literally no chemical substitute for silver in high-end electronic applications. You can't just swap it out for something cheaper.
Wow.
And Menton specifically names the drivers of this industrial demand, the green energy transition. Millions of electric vehicles are rolling off assembly lines right now.
Right.
Each one requires miles of silver line wiring, bus bars, and electrical switches. Billions of solar panels are being manufactured globally, and each one requires silver photovoltaic paste to convert sunlight into electricity. Modern medical devices, advanced military hardware, they are entirely dependent on physical silver to function.
So if gold is the heavy, inert insurance policy sitting safely in a vault, silver is the literal engine oil that is actively running the modern, high-tech, green economy.
That is precisely the mechanism.
Yeah.
And here is where the supply side creates the really explosive price action. Because when you lock a gold bar in a vault, the supply remains intact. You can always sell it later.
Right.
But when you consume a fraction of a gram of silver in a microchip, or a few grams in a solar panel, that silver is effectively destroyed.
Wait, really? It's not recycled?
No, because the amounts used in individual consumer electronics are so microscopic that it is economically unviable to recycle and recover the metal. It costs more to extract it than it's worth, so it just ends up in landfills.
Oh, wow.
Therefore, the above-ground stockpile of physical silver is constantly shrinking, while the mandate for green energy is causing demand to grow exponentially. We are currently running massive structural physical deficits in the silver market year over year.
That is nuts. So both engines are running at maximum RPM simultaneously. You have the monetary engine, investors fleeing the weaponized dollar and inflation, looking for a precious metal safe haven. And you have the industrial engine, the physical reality that manufacturers must secure millions of ounces of silver simply to keep their assembly lines running, regardless of what the price is.
And this dual engine demand is colliding with an inelastic supply curve. Silver mines cannot simply turn a dial to double their output overnight. It takes, a decade to permit and build a new mine.
Right.
So this tightening physical coil completely explains why analysts quoted in Metin's dispatch are confidently predicting silver will hit $100 an ounce by the end of the summer. The metal is riding the geopolitical fear wave that lifts gold, but it is supercharged by the uncompromising industrial realities of the modern world.
Okay, I think we have fully mapped the mechanics of this perfect storm.
Yeah.
We understand the domestic constitutional paralysis in the U.S., the steam engine pressure on China's currency,
Yeah.
the algorithmic panic surrounding the Strait of Hormuz, the sovereign rush into gold, and the literal industrial destruction of the silver supply.
Yeah, we've covered the whole board.
So the natural pivot here is to bring this directly to the listener. When the global macro environment is experiencing epoch-defining shifts at this velocity, how does an individual investor navigate the landscape without being completely paralyzed by the sheer volume and complexity of the data?
This is exactly where Metin transitions his text from being, a high-level geopolitical analysis to offering specific tactical survival advice. And he delivers a very striking warning using a really interesting cultural metaphor.
Yeah, he warns his audience about the danger of becoming a ball.
Right. If you're not paying attention, he writes, the market will turn you into a ball, a frozen stone monument of the past.
And for historical context, a ball is an ancient stone figure found across the Eurasian steppes. They were carved by nomadic tribes to represent deceased ancestors or fallen enemies.
Yeah.
They are rigid, they are unmoving, they are entirely locked in a past era, weathering the storms but completely unable to adapt.
And in financial terms, Metin is describing a specific psychological trap that captures so many investors. The bulbul is the investor who rigidly adheres to an outdated financial playbook while the foundational rules of the world change underneath them.
The people stuck in the old paradigm.
Exactly. Is the person who assumes that the traditional 60-40 portfolio, allocating 60% of capital to stocks for growth and 40% to government bonds for safety, will inherently protect them.
But the 60-40 portfolio was the absolute gold standard of financial advice for like 40 years.
And it worked brilliantly. It worked in a linear, disinflationary environment. In the 1990s and 2000s, if stocks went down due to a recession, central banks would cut interest rates, which made the value of bonds go up.
So the bonds acted as a ballast, protecting the whole portfolio.
Exactly. But in an environment driven by high inflation and physical supply shocks, like the Hormuz crisis we just discussed, the math breaks.
Because inflation crushes everything.
Right. Inflation crushes the purchasing power of the currency itself, causing the value of both stocks and bonds to plummet simultaneously. The ballast fails completely. The investor relying on the 1990s playbook becomes a stone monument, watching their wealth evaporate because they cannot conceive that the rules have changed.
Wow. Okay, so how do we avoid becoming a stone monument? Because Metin offers several tactical directives here.
He does.
The first, which we've exhaustively covered, is the absolute necessity of hedging. He states plainly that in the face of U.S.-Iran tensions, gold and silver are not just speculative investments, they are mandatory insurance policies.
Yeah.
But his second piece of advice is the one that completely subverts traditional financial education. Metin writes, quote, "Watch the news, not just the charts."
And this directive is a profound admission of how fundamentally the paradigm has shifted away from technical predictability.
Right, because traditional trading is heavily reliant on technical analysis. Analysts spend years learning to read charts. They calculate Fibonacci retracements, which use mathematical golden ratios to predict where a stock's price will naturally pull back and find support. They track 50-day and 200-day moving averages to identify algorithmic trends. They analyze volume profiles to see where institutional money is parked.
Right, it's very mathematical.
But you could have a mathematically flawless technical setup on a screen indicating a market is about to rally. And Metin is pointing out that we are now in an era where exogenous shocks rule everything. At 2 a.m., a politician hits send on a social media app announcing a new tariff, or a drone strikes an oil facility in the Middle East, and your entire mathematical model is instantly, violently vaporized.
Vaporized, because technical analysis is predicated on the assumption that markets move in recognizable, repeating patterns based on historical human psychology and market cycles. A chart looks backward to predict forward. But a chart cannot predict a constitutional court ruling on May 8th. A chart cannot price in an ultimatum of unprecedented military consequences from a Secretary of State. Metin is warning the listener that blindly trusting historical chart patterns in an era of unprecedented geopolitical volatility is financial suicide. The newsfeed, the physical reality of the world, now dictates the chart, not the other way around.
So if the charts are increasingly blind and the traditional portfolios are broken, what is the final tactical defense for the listener? How do you actually operate day to day?
Meton outlines it in his final directive. Liquidity is key. Keep some dry powder. Volatility is the new normal.
Dry powder, meaning holding cash or highly liquid, instantly accessible short-term instruments.
Right.
But, this advice feels intensely counterintuitive because every financial advisor warns that holding cash during a period of high inflation is a guaranteed way to lose money because inflation eats the purchasing power of that cash every single day.
In a stable economy, that conventional wisdom definitely holds true. But in a perfect storm, the primary objective shifts from maximizing yield to maximizing agility.
Okay, agility.
Metin isn't advising listeners to hold dry powder to earn a return. He is advising it because volatility creates massive irrational violence in the markets.
Walk me through the psychology of that. What does that violence actually look like for a retail investor?
Well, investors often feel an immense psychological pressure to be fully invested at all times, right? Driven by the fear of missing out on a market rally.
The classic FOMO.
Exactly.
Oh,
FOMO.
yes.
But let's say you are 100% invested in the market with zero cash reserves. Suddenly, a severe geopolitical shock hits, perhaps the Hormuz lock turns. The algorithms panic, and the broader market crashes 30% in a week.
Brutal.
Because you have no dry powder, you are trapped. You are the bauble.
Yeah.
You can only sit frozen and watch your net worth bleed out. You have no mechanism to respond.
But if you hold dry powder,
If you hold liquidity, you possess the single most valuable trait in a chaotic environment: optionality.
optionality.
When that massive irrational sell-off occurs, driving the prices of phenomenal assets down to incredibly cheap valuations, the investor with dry powder is not a victim. They are a predator.
Oh, wow.
They have the capital readily available to step into the carnage and acquire generational assets at a deep discount. As Metin describes it, you must be sharp as a wolf on the hunt. Liquidity gives you the fangs to capitalize on the chaos. Volatility is not merely a risk to be feared. If you are properly positioned with dry powder and precious metals, volatility becomes the engine of profound financial opportunity.
Volatility is the new normal. It is a sobering yet strangely empowering framework to operate within.
It really is.
Let's synthesize this entire journey. We started by looking at a radar screen showing multiple colliding systemic anomalies. We traced how a single, sudden court ruling in Washington, D.C., dismantling the America First 2.0 tariffs, instantly cascaded across the globe.
Yeah?
It severed the mathematical loop of domestic tax cuts, triggered a margin call panic that spiked the U.S. dollar, and simultaneously applied crushing pressure to foreign markets.
And we dissected how China is reacting to that exact pressure. They're actively attempting to construct a parallel financial universe outside the SWIFT system, while delicately venting the scheme of their currency peg to balance domestic real estate collapse against global export survival.
We examined how the physical world brutally asserts dominance over the financial world, with the seizure of a single tanker in the Hormuz choke point, sending oil prices skyrocketing, rendering central bank policy impotent and forcing trading algorithms to blindly price in apocalyptic military ultimatums.
Right, and we connected all of these massive, disparate geopolitical gears to explain the historic architectural rush into gold and silver. We separated the short-term commercial panic driving the dollar from the long-term sovereign strategy of de-dollarization through gold,
Yeah.
while also highlighting silver's unique, explosive position trapped between monetary fear and the uncompromising industrial hunger of the green energy transition.
It is a single, massive, breathing ecosystem of consequence. But as we close this deep dive, I want to leave you, the listener, with a final provocative thought to mull over on your own. It's a question that builds on everything Metin's dispatch has forced us to confront today regarding the death of traditional technical models and the rise of exogenous shocks.
If we are truly entering an era where volatility is the permanent baseline condition, and where a single, unpredictable geopolitical headline instantly shatters years of established mathematical chart data,
Right.
are the traditional formalized mechanics of modern investing fundamentally broken forever?
Or are we simply waking up from a brief 40-year historical illusion of artificial stability? Are we reverting back to a much older, much more primal era of human trade, an era where paper promises, digital ledgers, and complex financial algorithms mean absolutely nothing, and only raw, physical, intrinsic value truly matters when the storm makes landfall?
It is the defining question that every investor, and honestly every sovereign nation, will have to answer for themselves in the coming decade.
We want to warmly thank you, the listener, for joining us on this deep dive into the architecture of the perfect storm. Until next time, keep your eyes open, watch the reality of the news over the illusion of the charts, and most importantly, keep your powder dry. Because if the data in this dispatch is accurate, the storm isn't passing, it's just getting started.